In this presentation, I'm going to look at two different ways to induce or entice our bondholders that are holding convertible bonds to convert them into common stock or equity in the company. And the first way we're going to look at is the cash premium that we pay to our bondholders such they would convert those bonds into common stock. And then the second way we're going to look at is where we offer them a greater equity value or more common shares here to convert their convertible bonds into common stock. But we're going to be using the residual or incremental method here. So remember that, residual and incremental method. But before we get into that, we're going to just go through how we would allocate the bond value between the liability portion here and the equity portion on our balance sheet, since these convertible bonds represent both a liability and equity to the company. All right, let's go through our example here, and we're going to start out here when the bonds are issued. So we get a 5-year, $100,000, 7% convertible bond, and you can convert each bond into 25 shares of common stock. And the current market value of those stocks are $3.50 per share. So the first thing we have to do here is we have to determine the liability portion of that bond. And we do that by taking a similar bond without the conversion feature, and we would discount it back to its present value today. So for the example here, I took that similar bond and I discounted it back here to $96,150. That's its present value. So we'd increase our bonds payable amount by that amount here. Now we have to calculate the equity portion that we have to assign to that bond. And we do that by taking the bond's par value amount here, and in this case it would be $100,000, or we debit cash for that amount here as our asset. And then to determine the equity portion here, and in this case it would be in a surplus account, and it would be the conversion rights of those bonds. And we would do that by taking the par value of the bond less its liability portion here, and the difference here would be, in this case, would be $3,850. We'd credit our additional paid-in capital for $3,850. So here we assigned the debt portion of our bond liability here, and also our equity portion of our bond liability. All right, let's look at an induced conversion of these convertible bonds. And this is where we're going to pay our bondholders an extra amount of cash to convert these bonds into common stock. So the first thing we have to do is we have to determine the carrying value of these bonds at their conversion date. And I did that down here. So we would debit or reduce our bonds payable account by that amount here. And then we'd also close out this surplus account here for those conversion rights. Then the next thing we'd have to do is we'd have to reduce our cash account by the amount of that extra premium we paid to those bondholders. In this case, it was $1,500. So we have to go down here to record an expense for that debt retirement, and that's part of our net income on our income statement here. So to do that, we had to determine those bonds' fair value at the time of conversion. Those convertible bonds fair value, and I just use an example here of $98,400. That was their fair value. And then we would subtract the bond's carrying value that we had over here, and in this case I come up with $553 as an expense, or we increased our expense here for the debt retirement of those bonds. Then we go up here to the retained earnings, and that's really the difference here between this cash amount that we paid to the bondholders and the expense that we recognized here. So that was the difference here between $1,500 over here and the $553 worth of expense, and that was for $947. So the next thing we have to do is we have to determine the balance here in this common stock. That was the amount of common stock that we'd have to record for that bond swap here. And that's really a balancing entry here, where we take all these debit amounts that we had in bonds payable and the surplus account here and the expense account, and then our retained earnings. And then we'd subtract out our cash amount here, that credit to cash. And we'd come up here with a credit balance in this common stock. And in this case, it was $101,697. Okay, here we're going to look at an induced conversion where we offer our bondholders a greater equity value in the company. That is, we're going to offer them more common shares in exchange for those convertible bonds. And in this case, we're not going to offer them any additional cash premium. So just to start with here, we would close out our bonds payable by the carrying value of those convertible bonds at that conversion date. And also we close out this conversion rights or the surplus account here. So let's look at our numbers here. Now these numbers are only for demonstration purposes. So what we're going to be doing here is we're going to be giving the bondholders a greater number of shares than originally offered in exchange for those bonds. So we originally offered them 20 shares per bond, and that would have been 2,000 shares total that we'd have to offer. And then we increased it to 22 shares per bond. So if we go look at what it would cost, it would have been in the beginning here when we issued them, we would have had 2,000 shares. In this case, I used a $50 market price for a total cost of $100,000 here. Now at this conversion date, we actually offered them more shares. In this case, it was 2,200 shares total. And then our market price actually went down a little bit here. And this is only for demonstration purposes here. So our conversion cost would have been 101,000, or our total cost here would have been 101,750 here at the conversion date versus $100,000 at the original issue of those convertible bonds. So we have a difference here of $1,750. It would cost us $1,750 to convert those bonds based on the original cost. The idea here is we're comparing what we originally offered with today's deal on the conversion. And the $1,750 added cost would be recognized as a debt retirement cost or an expense on the conversion of those bonds, and that's part of net income on the income statement here. So technically our debt retirement cost here would have been the bonds fair value less the bonds carrying value. So I just plugged in the numbers here just to show that that should be $1,750. Now if we go back up here, and we'd have to come up with our balance here in the common stock. That's simply a balance between our debits here, the bonds payable, the additional this conversion rights here, and our expense amount. So just to review here, remember that when we're doing this induced conversion where we give them a greater equity value through the number of shares, we always compare what we originally offered on our conversion with what it would cost today at the new conversion numbers or new conversion quantities here. So it's the original amount versus what it would cost us today.